Today for Financial Literacy Month, I wanted to tackle a couple of myths and misconceptions regarding credit. And I think the biggest one that I see with a lot of the clients I work with nowadays is that if they're a couple, the significant other or the spouse, sometimes you tend to have one of them become the financial kind of decision maker of the household. And oftentimes they're the only ones that start to build credit. And so they say that the other spouse doesn't need to build credit. They'll never need it for any reason. But there are a few times when they could need it, and it could be helpful to start establishing that earlier. So I think it's probably most important if that other individual has an earned income, because if you are going to apply for a mortgage or anything like that, if you want that income to count towards that mortgage payment, to help you maybe get eligible to be able to receive that mortgage in the first place, then that's definitely a good reason to start establishing credit in advance. And typically you'd want to do so 2 years in advance, just so that there is starting to become more of a credit history for them to draw back on. Without doing that, if you're trying to count that income, most lenders will not, they'll either not count it or they'll reduce how much they're going to count towards your mortgage application. So very important to be aware of, especially with how hot the markets can be with home purchases. You don't want this to be something that has a deal fall through and then it's just kind of a pain in the butt. The next thing I wanted to tackle is the myth around you have to owe money on credit cards and pay interest to the credit card companies to build credit, and you don't. So that's one I hear all the time. I used to work at First Tech Federal Credit Union, and so there, when I was helping people understand how the credit works, that was a common misconception that they'd come in and think that they had to do, and I'd correct them. Obviously, I don't want people to pay interest if they don't have to, but basically how you can and how you should use credit cards is use them possibly with the rewards kind of tied to them, so that you can build credit and get rewards back for purchases and things that you would do anyways and normally. What you don't want to do is carry a balance on the credit cards. And so if you pay off the balance every single month, you actually don't pay anything in interest to the credit card companies. And then if you did happen to couple that with a rewards program, you're actually getting money back from the credit card company. So the credit card companies could be paying you more than you're ever paying them for use of that credit card. And so that's the way I typically recommend my clients use credit cards if they're going to use them. And by doing so, you're not paying anything in. You're still building great credit score just by doing that. So hopefully that if any of you were thinking anything like that, this corrects that issue and you can start focusing on paying that off and making sure that you never pay the credit card companies another cent. The last thing that I wanted to hit on is also a very unknown situation where you have multiple credit scores. There's the FICO credit scores, but then most institutions, and again, I saw this at the credit union when I was working at it, they kind of repackage and rebundle your credit report into information that they feel is more valuable than others. So they'll weight your credit score based on different criteria than what your normal credit score would look like. And so that's a reason why if you apply for an auto loan, you might get back a different credit score than if you're applying for a credit card or a mortgage. And so that's something that a lot of people don't realize is you have multiple credit scores, and it depends on the institution pulling it, as well as what things they care about to weigh more than others. And so that's something to be aware of. And one of the reasons to have a little bit more diversity in your credit, so not just having credit cards and not just having a single auto loan or something like that. If you have more diversity there, it is going to help no matter how these companies want to try to tweak and weigh different factors more than others. Ultimately, as long as you're paying stuff on time and you have an extensive history of your credit, you're going to have a pretty positive score regardless. But this really impacts people earlier on. As they're starting to build and establish credit, that they think that they got this one card and they have a really good credit score when you factor that in. But you go to the credit union and try to get an auto loan. Well, you've never owned an auto loan, so they're trying to weight that auto loan that never existed for you, and then they're paying little attention to the credit card that you did have because it was a really puny one. Maybe it's one that you just got right out of college or right out of high school, and so they're like, a measly $500 credit limit is not nearly the same as your new $30,000 auto loan that you're trying to apply for. So they're not going to weigh those things the same. So that's another one that I don't think anyone ever realized, and I didn't know until I was working there and kind of seeing the different number crunching going on. But something to be aware of because it could impact how much you potentially pay. Hopefully that's all helpful information and you're a little bit more financially confident when it comes to your credit situation moving forward.